Hi everybody, this is Asahab. I'm Giacomo, and today we're going to do a stock analysis. Today I'm joined by Eric Gruvenoff. He is a contributor on Seeking Alpha, and he recently wrote an article on Crocs and why he thinks Crocs has a great opportunity to grow exponentially in the near future. So it's a great pleasure to have him on my channel. And so please, Eric, introduce yourself and then we'll jump into the analysis.
Sure. My name is Eric Rubenhoff. I started blogging for Seeking Alpha about 2 years ago. And once I started blogging, they helped me with correct formatting for writing articles and such. And once I started blogging correctly and my predictions started coming true, they allowed me to start writing, even though I don't necessarily work in the finance field. And then since then, they've just been letting me write more and more. And I found Crocs about a couple of months ago, and it really caught my interest with the business model and such like that. So this is the actual article right here, right? I'll take you through it step by step. Reason I have this Netflix over here, right, is one of the things I look at when I look at a stock is I'll pull up my little homemade spreadsheet over here. I actually do not look at cash flow, which may sound very counterintuitive. Like, why would you not look at cash flow? What kind of investment person wouldn't want to look at a statement of cash flows, right? The main thing I look at is operating income, right? So that's why I have this Netflix right here, right? If you look at the Netflix statement of cash flows from 2014 over to 2019 over here, right? So you have a major contraction of cash from operations from 97 to 16. Then you have cash flow losses, right? Yet Netflix, even with this negative cash flow, has monstrous growth, right? So because I'm not a CPA and such, obviously, I mean, I shouldn't even have to pull up the chart for Netflix. We all know what Netflix has done, right? Which is why I look at operating income. It's the simplest way to really understand what a company's doing, right? And with Crocs, with their financials, right? So I look at their operating income, and another way you could really see the real performance of a company, right? Sorry, my internet's a little bit slow here. Annual, and then I do it as a percentage of revenue, right? So if you look at their operating income as a percentage of revenue, you see a constant increase of their operating income as a percentage of their revenue, right? So each year, it's getting larger and larger as a percentage of the revenue, which means they're increasing their efficiency, right? And this is also evident on the spreadsheet over here. This is just a basic percent change. So, 12% from 2019 sales growth. Sorry, there you go, annual revenue. Then over here, 65% from 2019's operating income. And then this column here is operating income minus revenue growth, right? So you have a 53% difference, which correlates to this growth over here, right? How much bigger operating income is getting as a percentage of revenue. So this is one of the basic things I look for when I look for in a spreadsheet. And I was talking to Giacomo the other day, and if you look at Netflix, their operating income, consistent black, not too much red, right? So that is the number one thing I look for. So when I found Crocs, I guess I'll pull up my article over here. Basically, I look at the business model. It's much more than a seasonal fad. Many times in this article, I referenced how they were thought of as a fad and how they're going to die. And one toward the bottom, let me just do I can't do my keywords right. I guess it's toward the bottom. Here we go, Time Magazine. Time Magazine, if I would click this link, it would show you Time Magazine actually wrote a piece, the 50 worst inventions of all time. And in this, Time Magazine called it pop-up ads. You remember pop-up ads on computers, and asbestos, also 2 of the 50 worst inventions of all time. And Crocs is in there with that list, right? So these critics don't necessarily know everything all the time. Let's just put it that way, right? So I started with the my intro was about things that I thought were stupid. stupid, right? Like I thought Bitcoin was stupid. I thought a phone without a keyboard was very stupid. I thought a website going public was very stupid. I thought an electric car was very stupid, right? And when I first saw a Croc, I'm like, that's the dumbest thing I've ever seen. Why would anybody wear that? And they wear it a lot. And they're run really efficiently. And I have the charts in here about their gross margin, right? Gross margin, does that click? Yes, it does. Compared it to Nike and a couple of other, like Deckers. Deckers is the creators of Uggs. Rocky is like hiking boots, right? And I just could see, move you out of the way. You're in my way, Jack. Come on. It's getting bigger, right? And more proof of that their margins are getting larger. First of all, they're the highest on this whole screen, but more proof of that is the spread with the operating income and the revenue and the percentage of revenue of operating income. So you see, I have three, how do you say, correlations that are the same, right? Because the accounting can get really fancy with this finance stuff. So, I really don't want to get fooled with this stuff, right? So I talked about the moat. I talked about it over here. When you look for something, you Google it. When you want to copy something, even if your printer is an Epson, if you say make a Xerox of this, you still know what it is. So when the company becomes in the language itself, right?
Yeah, that's a big moat. And
right, exactly.
Talking about moats, Crocs doesn't have a clear competitor like Ford with General Motors or Nike with Adidas and so on, right?
Right. So, that's pretty much how I got it. This actually, Seeking Alpha only lets you put one image per article. Now it's like their new rule for the last couple of months. But this really shows look at this. People like Snapchat had a Crocs filter and 10 million shares of the Crocs. Wow, I don't look at all these pop-ups. Speaking of pop-up ads, right? Get out of here. It shows how it made it cool, so to speak, right? So if you're gonna have 10 million, what did I say over here? 4 million shares in 10 days. 10 was in there somewhere, right? So obviously they're doing collaborations efficiently with advertising. And it doesn't necessarily, because of the efficiency and scale now with the internet and such, really won't take 20 or 30 years to have a sharp goal like that. With targeted advertising and globalization, you really can have an explosive company in just 5 years, right? And with this valuation, we're in a little bit of a bear market right now, obviously, but go back to my basic, I can get rid of my Netflix thing over here. You're talking about a PE, a single digit, with this type of growth. In my opinion, the reason for it is because, as you can see over here, the growth is, PE is 11. I think the market just thinks it's a stupid shoe. They think it's ugly. They think they would never wear it, and they're ignoring consumer behavior, which presents a buying opportunity for me. And I will say, where's my article? I think it went down a little bit since I wrote it too. The price of publication over here. Yeah, it's down 10% since I wrote about it. But if your window is a 5-year window, to me, it's just, especially if you dollar average cost it over the course of the next year or so, and you just keep accumulating, you could see a very hefty return.
Yeah. Okay. Can we go back into the financials and see what the margins are and what are the growth expectations that we can foresee in the near future for the stock?
Yeah, sure. According to analysts, this is what they're predicting. They're predicting $3.5 billion for the 2022 fiscal year, right? Which, if you look at here, that's Netflix. That's why the numbers are out of whack there. So for the fiscal year 2020, right, they had 1.3 billion, and look at how much their operating was as a percentage of that. So if the operating income were to correlate, you could see a really, really significant return. So their EP, these are from the, the bankers and such, let's do this, the annual. That's the earnings per share estimates. Obviously, this is last year, which is the spreadsheet we just saw, and they're really expecting this to go up. I believe in the transcripts, management wanted to get it at 5 billion in sales by 2025.
All right. All right.
As you can see over here, Seeking Alpha. I don't know if anybody on your YouTube channel is a member of Seeking Alpha. I'll just open this up real quick. This is their footwear little sector over here. It'll show profitability. It'll show growth. So it's rated A for growth. It's the highest out of all of them. A plus for profitability, except for Nike. And as in the chart I just showed you, it has a higher gross margin than Nike. Momentum, meaning has the price moved recently? It's a little bit down, but that's just the market in general. And obviously Nike, really what I'm noticing in the market right now too, like the bigger blue chips, the S&P, they've seemed to have been the safety net. So if the market's going to go down, rather than putting it into treasury and gold, they've been putting it just into blue chips, which is what I've noticed. So in here it's included Skechers, Steve Madden, and you might notice some brands are missing here, which actually I like this, right? So you have Reebok, you have Adidas, you have other shoe brands, but they also make hats and they make jackets. So this actual sector, footwear stocks, these are like mainly footwear, like that is their niche. And because Crocs really isn't making t-shirts and such, it allows them to really focus on what they're good at. So these are what they think. I think these are low estimates. In the article I referenced Australia, how in the last couple of years they saw like a 430% from a 6-month period earlier, which is just a monstrous. And everybody talks about emerging markets and they forget about this giant continent out below Asia where there's a lot of people there. So, it's pretty significant. And over here, I talked a little bit about Asia and I did a quarter by quarter going back, and EMA, Europe, Middle East, and Asia. That's what EMA stands for. And they've already really done well in the American market, and they seem to be going worldwide. And the ability to go worldwide is very different now than it ever was before. These companies can really do it, and they can do it well.
Yeah, for sure. The digital platforms that we have makes it a lot easier for them to go elsewhere compared to only the Americas or just the United States. That's for sure.
Right. So, yeah, as you can see here, Seeking Alpha gives you the PE forward, PE, trailing, and the trailing is actually 8. It's a single-digit PE for last year's, and such. And it's just, I just think it's a very, very obvious investment. A $5 billion cap, which at $5 billion seems like a lot. It is a large company, but if you look at Nike's cap, right? Obviously, Crocs is nowhere near Nike, but $227 billion. So if Crocs were to become 10% the size of Nike, you're talking about a 4-bagger from today's price. And then, this is just the average of the last 5. So this is the last 5 average revenue growth. So this is just a basic average formula. So equals average, and then you plug these 5 numbers in there. Then I have the first 10 average if I wanted to do like a historical lookup, right? Over here, I have cash on hand, right? This is total liabilities. So this is the ratio, right? So at a high margin company, I wouldn't worry about this too much. But in general, I like to see this number getting bigger rather than smaller over time. So Netflix, when I reference Netflix, I'm referencing what Netflix looked like 10 years ago. I actually would not invest in Netflix today because I'm looking for the next Netflix, so to speak, right? So here's quarterly cash on hand. This all looks very complicated. It's really not. These are all very, very basic formulas, right? So here's quarterly revenue, and I did it from, so as you see, 930. This is 930 here. So this is from the year before, right? This is the net income, right? So you saw a slight decline in net income. Now, net income obviously is more complicated than operating income. Net income includes taxes and all this other fancy accounting stuff. So my preference is operating income. It's just very blunt and simple. And this is the spread. Basically, this is percentage of this growth minus percentage of that. So as you see, this is what I talked about in the beginning of the video with the margins and such with Crocs, right? So this is when I started looking at historical spreadsheets, and this is what I was noticing. I was noticing that the home run investments have a lot positive. The net income is growing at a faster rate than the revenue, right? So I happen to have the operating over on this side just because I ran out of room and whatever, right? So operating income minus revenue. They're still doing it. Netflix is still doing it, right? These are great numbers, right? So it's still not a bad investment. And as you can see, look at all this red look at all this black as opposed to red, right? And this is, it's just some more averages I have up here. So this is the last 5 of operating income growth, the last 5 quarters. This is the last 10 quarters, right? Which it's still a great investment, really. I mean, 78% average for the last 10 quarters is phenomenal. And this is the spread average over here. So over here is just operating, like if I would do this, right? So this is the operating income, this 33% minus, you'll see the other highlight over here, the revenue growth, minus that number.
Yeah.
Right. So let's say the last 10, 54% spread over the last 10 quarters, which is still very, very great. So when I did Crocs, you'll see the similarities right here, right? I didn't call these red yet, but lots of positive, right?
Yeah.
If I were to go down here, right? Same thing, lots of positive, right? So does this correlate, right? Well, that's historical. Let's do a 5-year. 5-year, 10 bagger in 5 years, right? Yeah. So really what the spreadsheet tells me is that if I'm hunting enough, I really don't need options. I really don't need to time the market.
So I think you made it pretty clear on what is the trajectory that Crocs is on, and the revenue growth, the margins, and the new markets that are opening up. So that looks that it could be a smart investment. So I want to thank you for your contribution and for showing your investment strategy. So thank you for being with us today.
Sure. Thanks for having me.
I'm Giacomo. This is Hustle Hub. See you next time.